Hi traders. In this video, I'm not actually going to give you any trade ideas, but this is more about analysis and trying to basically discuss what is my view on this rather actually sensitive and recent topic, which is basically whether the market is actually crashing because of coronavirus or not. And we're going to just look at from the technical point of view, and the purpose of this video is not to actually make any kind of judgment. It's just basically just trying to see, like, if these kind of events happen, like, I won't categorize this as of it yes, as a black swan event, but it is nonetheless a very important and impactful event worldwide. So what has been happening? If you have been following the news items and media, then you might have seen, like, markets are crashing, and it's going to be another recession and all that. So what exactly is happening? Let's look at S&P 500, because a lot of traders actually around the world look at S&P 500 as one of the leading parameters of market recessions or something like that. And historically, it has always been in really good bullish movements. So let's look at that, and I'm basically using a stock chart which is on TradingView, and I do not have the entire data. As you can see, this is going up to 2015, and most recent is 2020 Feb. So we'll be just looking at that. And let me remind you once again, the purpose is just to study what actually happened when they said the market is crashing. Right. So if we start from here, and by the way, we are looking at the weekly chart, and we can actually start from monthly chart, but because we do not have much data around here, so I'm not sure whether it actually makes any sense. But let's look at it anyway. So market has been going upwards here, and then it created this V kind of structure. And if you have been following my ideas, then I suggest that I call this something called extreme prices, when the market has gone extremely high and it pierces this upper Bollinger Band or lower Bollinger Band, and then comes back down and creates a double top or divergence kind of thing, and then it falls back to the mid of the Bollinger Band, and then if that doesn't hold, then it goes to the lower of the Bollinger Band. So if you apply that theory, then you can actually see that this is understandable. Now, if that is true, then you should look at the drop that actually sorry right, if that's true, then you should look at the drop that it has taken from high point, which is 2955, all the way to 2348, and that happened in what, 3 months. Okay, now if you look at this, which is the recent drop, and it has been actually going on since the entire February, actually, not just like the start of the February, or like something like that. The thing was actually building up, and you can see there was a rejection candle in January. This candle is February, and the current green candle is actually March. So if you see, the market actually was actually giving us a reversal kind of sign in terms of this kind of like doji candle. Market went up, could not hold it, came back down. Now where it came to? It came to the mid of the Bollinger Band, which is actually quite understandable, because that's what it does. The market actually comes to this and then creates a rejection. So when the market came to the mid of the Bollinger Band, what do you expect? You expect a rejection, and that's what we are seeing in the month of March so far. So that's on monthly. Now on weekly, same kind of story. So market could not hold the mid of the Bollinger Band. Where it came to? It came to the lower end of the Bollinger Band, and now we can see a little reaction. So if I go to the daily and show you a few things, if I turn my analysis on, then you'll see what I'm talking about. So this is what actually happened. So if you see, from 23rd of Jan, which is right here, and 19th of Feb, near about 18th Feb, you can say 18th or 17th of Feb. So between 23rd of Jan and 17th of Feb, market was actually giving us uh, divergence. If you see RSI, there was a divergence here. So anyone who had this knowledge of this kind of technical analysis knew that market was going to go down. And if you look at it, market has been bullish. It tried once, tried twice, tried thrice, and if you see this particular structure, just this structure, in this case the market came down and then went back up into the upper half. In this case, market came down, went to the 20 SMA, mid of the Bollinger Band, fell down, and then started going back up, creating this divergence. And that's what I was talking about. You know, that extreme prices, it's the same structure. Market comes to this mid of the high of the Bollinger Band or lower of the Bollinger Band, then comes back down and then creates this V structure, goes back up, creates a divergence or double top. So this was a double top that actually formed in the month of February, around 17th or 18th. So people who traders who were actually familiar with this pattern, they knew that market was going to go down. Now, did they know that it was going to go down all this way? Probably not, but they knew that market was going to go down, and if that was the case, then they could have started taking profits. Now, if you are long in a position and you're taking profits, that means the market is actually going to go down. So if the market actually, if all the traders or majority of traders start to sell an instrument, then supply will be more than demand, and that basically means that market price will go down, and that speeds up the process. Nonetheless, on top of that, coronavirus reaction actually happened. So everybody thought, oh yeah, it's going to impact the market, so let's sell. But I would argue that majority of those sells were not actually based on coronavirus, but based on this factor, which was actually telling us in advance that it was going to happen. Now, why it actually fell to this level? Now, according to my theory, which is basically just my way of technical analysis, now you may argue, you may agree or disagree with this, but this is just my theory. Now, if you look at this, this is our first structure here. When the market is falling, this is our first structure, but it's a weak support, because if you look back, there is nothing in here. It's a weak support, and this support is actually a reaction of previous support. So if you study the demand and supply or demand rather, so this is not a fresh demand, because it's a reaction of the previous demand that was created around there. So, and this demand has already been consumed. So when the market came down here, it actually broke through that. So this is a weak support. Market went through this. Now around here, this was supposed to be actually a good demand. However, market was actually in this downfall momentum, and it didn't stop. Now what we can do here is we can actually bring in our Fibonacci and measure this entire leg, and let's see if anything was actually around that. So you can see this is 61.8. Now market did not stop at 61.8 and previous support level. One of the reasons that I can think of is actually because this again support was actually another weak one, because this was a bear candle in here. However, nonetheless, this was a support, and we should agree that this was a support, even though it's not one of the best supports, again, because there was nothing in here for a long time. So market did not stop here. Now this part was actually after 6.18, this Fibonacci level, this part was probably an overreaction. However, this one, the initial reaction was, I would argue that that wasn't actually an overreaction. This was an overreaction of overall market fall. However, that contributed to the overall fall, and this fall was actually very rapid. Now that rapid fall actually started, in my opinion, it started like, creating a panic in the market. It's not the amount of fall, because if I go back to the monthly chart, you see this fall from here to this point is nothing as compared to this one. This is much bigger than that one, And we do not have the data here, but I've seen it on Yahoo Finance. You can do the same exercise. You can go to the Google Finance or Yahoo Finance and find S&P 500 chart, and you'll be able to see that this kind of fall is actually nothing new. This has actually happened. The only thing that has not happened is the rapid fall, is the speed of the fall that actually happened. So market fell very at a high speed, and then fell to what? It fell to a previous structure. Now this one is a better support zone because we have previous structure here and we have bull candles around here. That basically means the trend actually initiated from here. So all this entire thing actually started from here. This is the base. So this is a good demand. So market actually fell down to this level, and now as soon as it fell, market started to go back up. Now, as of now, if I take the Fibonacci from top to bottom of this entire move, I can see that market has already come to 38.2, which basically means nearly 40% of that fall is already covered. So would you consider this as a crash or a kind of retracement with a little overreaction? Honestly, however, the market has actually recovered, regained like 40% of it. Now, how could you have played this if you knew something like this was going to happen? First of all, if you do not play indices, if you do not trade them, do not do them unless you know what you're getting into. Second thing is that you could actually find out about this divergence. A lot of traders actually knew about this, so they could have initiated the short position. Otherwise, they could have just exited their long positions or covered their profits, taken partial profits, things like that, because they knew that something could happen and market could actually come to at least to the first support level, followed by the second support level. Market could actually come there. Now, there'll be a lot of traders who were actually waiting around here because they knew that this was a good support zone, good demand zone. So that's why the market started moving up. And as you can see, this is actually an engulfing candle which has engulfed the previous one, and that indicates more upper movement. A market may actually start moving upwards. Now that's not guaranteed because now they can be later, they can be more reactions in the market. However, just from the pure technical point of view, this is an engulfing candle. It has engulfed the previous one. It's a very strong candle, and we can expect market to actually continue a little further. So this is what I thought of S&P 500. Now I leave it with you whether you consider this as a crash or what is your opinion. In the comment section, let me know what is your opinion, how you played S&P 500. Were you actually involved in this trade, or are you involved in S&P 500 trade right now? And what is your opinion, what is your analysis, and what is your comment? Let me know in your comments. And if you enjoyed this analysis, please do not forget to hit the like button and subscribe to my channel. Thank you, and I'll see you in the next video. Thank you.